Yeah, once again, good evening. Please, as a standard, let us mute our speaker. Check to ensure that your speaker is muted so as to avoid external interference with the lecture. If you have a question to ask, please signify by raising up your hand. All right, tonight we continue from where we stopped. Our last class, our first class, we looked at capital structure and theories of gearing. Let us do a recap of the last class. We defined capital. Capital is the money used to create a business, to build a business, and to run a business. That is capital for you. The money used to run to create a business, to build a business, and to run a business. Basically, there are two types of capital: equity capital and debt capital. Equity capital is the capital contributed by the owners of the business. The owners of the business are the shareholders. While debt capital refers to all forms of borrowing, including preference shares. Thereafter, we look at what is capital structure. Capital structure of a company refers to the different types of capital a company uses to carry out its activities. The capital structure of a company shows the different combination of capital a company uses. The capital structure may include ordinary share capital, preference share capital, and long-term debt. A company may be financed by equity only. Such company will be referred to as a geared company, as an ungeared company. Where a company is financed by equity capital only, we refer to such company as an ungeared company. Sorry, as a geared company. Alternatively, a company may be financed by a combination of equity and debt capital. Such company is referred to as geared company. So, a company may be geared or ungeared. Where you finance your business with equity capital only, then you are regarded as an ungeared company. When you finance your business by a combination of equity and debt, then you are regarded as a geared company. We now look at risk, the business risk, and the financial risk. Your business risk, that is the risk that has to do with the nature of your business. The business risk is the risk that A company may achieve low profits. Or the company may incur losses due to the nature of the business the company is involved in. Adesuapli, can you mute? So business risk has to do with the nature of your business. We look at financial risk. The financial risk is the risk over and above the normal business risk. Financial risk has to do with debt financing. When a company borrows money, then that company has introduced financial risk into its business. Later, we will look at the theories of gearing. We explained that there are two major theories of capital structure. There are two major theories of capital structure. This theory tries to look at the impact of capital structure on the company's cost of capital and on the company's corporate value. Let me explain that again. These two theories try to look at the impact of capital structure on the company's cost of capital. The question is, does company capital structure affect the company's cost of capital? The second question is, does the company's capital structure affect the company's market value? That is the argument between the school of thoughts. The first school of thoughts, the traditional theory of capital structure, they argue that company's capital structure will affect the company's cost of capital and will affect the company's corporate value. How you finance your business, the argument is that, according to the traditional theory, their argument is that how a company is financed will affect the company's cost of capital. And hence, we affect the company's, once your cost of capital is affected, then that will affect the corporate value of the company. That is the argument of the first school of thought, the traditional school. They argue that there's an optimal level of gearing. This is when we say gearing. Gearing means borrowing. Gearing means bringing debt finance to the business. So at any point in time, we mention gearing. It means we are bringing in debt finance into the company's business. So the first school of thought argues that there's an optimal level of capital structure. There's an optimal level of gearing for every company. The optimal level is achieved at a point of gearing where the weighted average cost of capital is at minimum. Ibukunla, please, can you mute? According to the traditional school, the optimal level is achieved at a point of borrowing where your weighted average cost of capital is at minimum. Once you achieve minimum WACC, then you have reached your optimal level of gearing. We now have the second school of thought, the Modigliani and Miller theory. Modigliani and Miller argues that there is no optimum level of gearing. They challenge the position of the traditional school and argues that there is no optimum level of gearing. Excuse me, please. Please, 1 minute. Okay. They argue that there's nothing like optimum level of capital structure. If you like, finance your business with equity. If you like, finance your business with debt. Or if you like, finance your business with a combination of equity and debt. That will not affect your corporate value. And that will not affect your cost of capital, provided there is no taxation. Their argument is based on the fact that once there is no taxation in the economy, please, can you mute? The argument of Modigliani and Miller is that once there is no taxation, how a company's finance will not affect the company's cost of capital. And once your cost of capital is not affected, your corporate value will not be affected. They now gave us, they developed formula, or they developed two propositions. Look at it, please. M&M without tax. Let me run through this. Yeah, look at this.
I don't want to took on inside the mystery.
Yeah, Modigliani and Miller without taxation. Yeah, look at it. Zoom user are actually disturbing us.
Okay.
Your speaker is on.
Okay.
And
I think last week. Yeah. No, listen, for when you to pray, you say water.
On 2 days, that day, when I
Have you
seen that it's possible?
Yes, now, when I use Monday. Just bring it to you.
He's not aware he's interrupting the class.
This Nepal is new we're talking about.
I'm trying to mute the Zoom user. Please, can you mute?
I'll call collect.
It does get me tired.
Even the Zoom user don't know he's a Zoom user. So the name is not familiar to him.
Emmanuel, please, can you mute?
No, I'm only commenting on the other Zoom user who is.
Hey, don't worry, just mute. Thank you. Let's continue. Where there is no taxation, M&M argued that the weighted average cost of capital of a geared company is the same as the WACC of an ungeared company. The cost of capital of a geared company will be the same as the cost of capital of an ungeared company, provided there is no tax. In as much as they have the same WACC, then the corporate value of a geared company is equal to the value of an ungeared company, in as much as there is no taxation. Next, proposition 2. The cost of equity in a geared company is higher than the cost of equity in an ungeared company. Because a geared company, you are going to have financial risk and business risk. While an ungeared company, you only have business risk, no financial risk. Hence, the cost of equity of a geared company will be higher than the cost of equity of an ungeared company. We have this. Cost of equity of a geared is equal to cost of equity of an ungeared plus bracket cost of equity of an ungeared minus cost of debt, close your brackets, multiplied by value of debt over value of equity. We explained this last week. We now look at Modi, Glanley, and Miller, where there is taxation. MMM revised their theory or amended their theory, their initial theory, to include corporate taxation. Modi, Glanley, and Miller revised their initial theory to include corporate taxation. The inclusion of corporate taxation significantly changed their conclusion. They argue that where there is corporate taxation, that will affect the cost of capital of a company, and that will affect the value of the company. Where there is corporate taxation, the capital structure or the level of gearing will affect the cost of capital of the company. And once your cost of capital is affected, that will affect your corporate value. In their opinion, companies should take advantage of debt finance because with corporate taxation, the value of a geared company will be higher than the value of an ungeared company. Where there is corporate taxation, the market value of a geared firm will be higher than the market value of an ungeared firm. Also, where there is corporate taxation, the cost of capital of a geared firm will be lower. Your cost of capital, that is the weighted average cost of capital of a geared company, will be lower than the WACC of an ungeared company. Why? The reason is because the geared company will enjoy tax relief on debt capital. When the company obtains borrowing debt, the company will pay interest. That interest is tax allowable. By paying interest on your debt, the company will claim tax relief. The tax relief can be used to reduce the cost of capital of the company. Reduction in your cost of capital will enhance the value of the company. With corporate taxation, the WACC of a gears company is equal to the WACC of an ungeared company multiplied by the financial risk premium. Financial risk premium is 1 minus value of debt multiplied by tax divided by value of debt plus value of equity. Next, value of a geared company is equal to value of an ungeared company plus the tax sheet. This is called tax relief plus the tax relief. The value of a geared company will be higher than the value of an ungeared company. Geared company will enjoy tax relief. Debt multiplied by tax is the tax relief, or you call it tax sheet. Lastly, the cost of equity in a geared company is higher than the cost of equity in an ungeared company. The formula will change slightly with taxation. We introduce taxation here. We explained this last week, and we couldn't put questions to this discussion. So we have tried to do a recap for like 20 minutes of our first class. We now go to question. Please refer to your study pack. Check your study pack. I think page 150 or page 151. Look at question number 1. Tesla PSC. Please, as much as possible, get your writing pad, your writing material, your calculator. Assume that you are in a physical class. If it is necessary, please jot down. Are we good to go with this question, please?
Yes, sir.
All right, I'll read. Tesla PSC sorry for that, please. Tesla PSC has a geared capital structure. Look at that statement. That means Tesla is financed by equity and debt. Tesla PSC has a geared capital structure. That means that capital structure, there will be debt capital and equity capital, with details as follows. Value of debt, 200 million. Value of equity, 300 million. Total value of the company, 500 million. Value of the company is value of debt plus value of equity. Next, existing cost of debt before tax, 12.5%. Existing cost of equity, 20%. Tax rate 40%. Next. The company proposes to raise 25 million naira of new equity and to use the finance raised to repay 25 million naira of outstanding debt liabilities. Look at that statement. The company is planning to bring in more equity finance and use the money to reduce outstanding debt liability. All earnings are distributed either as interest or dividends. That means there's no retained earnings. All our profits are distributed either as interest or as dividends. Requirements A. Calculate the existing WACC, earnings before interest and tax, and return required by the ordinary shareholders to compensate for business risk. Let us tackle A first. The question says, calculate the existing weighted average cost of capital. That is the weighted average cost of capital before the proposal. So my question to the class is, what is weighted average cost of capital? And how do we compute weighted average cost of capital? I'm not sure you have gotten to that. I'm aware you are doing cost of capital currently with you, but I'm not sure you have gotten to that. If you want to define WACC, the weighted average cost of capital is the average cost of all the different types of capital the company uses. That means we are going to look for the average cost of, like this question now. This company uses debt capital and equity capital. So if I want to calculate WACC, I'll look for the average of the cost of equity and cost of WACC. Average of the cost of equity and cost of debt. This average is weighted by the market value. Now, what is the formula for WACC? We have like 3, 4, up to like 4 formulas. And all the formula will always give you the same answer. Let's go to the whiteboard. You can calculate your WACC as the formula on the board on your screen. WACC is equal to KE multiplied by VE, close your bracket, plus open bracket, KDT multiplied by VD. Everything divided by VE plus VD. Your KE is cost of equity. Your KDT, that is the after-tax cost of debt. After-tax cost of debt capital. Your VD, that is the value of debt. You now multiply your answer by percentage. You can use this to compute your WACC. You can also compute WACC as EBIT, earnings before interest and tax, into brackets 1 minus tax, divided by value of equity plus value of debt. Everything multiplied by 100. Ash total. Now, please note, this formula we have given you. All right, sorry, I have a temporary network glitch, but we are back. Let's go on with the class. Now I'm trying to mention a very important information here. The above formula assumes that the capital structure contains just 2 types of capital. Some question, your capital structure might contain like 3, 4, 5 types of capital. In that case, you need to adjust the formula. Assuming you have preference share capital, then you are going to adjust the formula to include cost of preference shares multiplied by value of preference shares. You now add to the denominator plus value of preference shares. So, but not worry, Adejuwa will do more on this. Now, let us compute the existing cost of capital. Go check. This is cost of equity. Let me pick my pen. All right. Now let's go back to the question. What is the cost of equity? Please open your question. Existing cost of equity 20%. Pick that. Cost of debt before tax 12.5. So we come here. The cost of equity currently is 20%. That is equal to 0.2. Next, the cost of debt. We are giving the cost of debt before tax to be 12.5%. But we need to compute after tax cost of debt. To do that, we are going to introduce 1 minus tax. That will give you your cost of debt after tax. That becomes 12.5 into brackets 1 minus the tax rate. Look at the question. What is the tax rate, please?
40%.
Hello, guys.
40%.
40%.
40%.
The tax rate is 40%. Now, please work this out. Thank you, please. Calculate 12.5 into bracket 1 minus 0.4. What do we have?
7.5, sir.
7.5.
7.5. 7.5.
Please get your calculator closer. It shouldn't take long. 7.5%. Thank you. 7.5%. That's 7.5%. As given in the question, 300 million. What is the value of debt? 200 million. That means you can compute your WACC now. You can compute your WACC now. Yeah, come here, let's move fast. That means our WACC is equal to the WACC is equal to, open a bracket, cost of equity, 0.2, multiplied by value of equity, 300 million, plus another bracket, after tax cost of debt, 7.5%, that will be 0.07 million. Everything divided by value of equity plus value of debt. Please work this out. What is your existing WACC? Multiply your answer by 100.
15.
Please work this out.
15%.
What is the existing WACC? Thank you, 50%. Thank you, please. The existing WACC of this company is 50%. We are done with that. Next, examiner says calculate existing earnings before interest and tax. Roman figure 2 says calculate existing earnings before interest and tax. In exam, you must be smart. You want to calculate the profit before interest and tax. You don't have any information, but you are aware that you can calculate your WACC as EBIT into bracket 1 minus tax divided by value of equity plus value of debt. Fortunately, you have calculated your WACC here. That means you can use this formula to derive your EBIT. I'll just come here. WACC is 15%. This is equal to EBIT bracket 1 minus tax. Tax rate is 40%. All over. Value of equity is 300. Value of debt is 200. That means this will give me 0.15 is equal to EBIT bracket 0.6, 1 minus 0.4, that will give us 0.6, divided by 300 plus 200, 500. We can cross multiply. This is equal to 0.15 multiplied by 500 is equal to EBIT bracket 0.6. Let me
Answer is 125, sir.
my chart.
Oh, sorry.
What is the formula for EBIT? EBIT is profit before interest and tax. If you prepare your financial income statement, you are going to see your profit before interest and tax. So there's nothing like formula here now. You prepare accounts. So nothing like formula for EBIT now. EBIT is simply earnings before interest and tax. So what is your EBIT? That will become our EBIT. Please multiply. 0.15 is just 1 minute. Let me create more space. Let me create additional space for this. I have this. Let me see this my work. Okay. Let me create like 2 space or 3 space. I was trying to just prepare the schedule so that it can be faster for us in class. Okay. I'll take this off now. So please, there's no formula for EBIT. Your EBIT is your profit before interest and tax. That is your operating profit. So 0.15 multiplied by 500, that will give us 75. This is equal to EBIT bracket 0.16. What is EBIT? Divide both sides by 0.6. Divide here by 0.6. Divide here by 0.6.
125, sir.
This will strike out
125.
this.
125.
Our EBIT is equal to 125 million. You have resolved A Roman figure 2. So please be smart in your exam. And that is another reason, please. If you have like 3, 4, 5 formula, try to understand all the formula. Because at times, in some question, that formula you cram might not work for the question. Deliberately, the examiner didn't give you cost of equity, cost of debt. He now gave you EBIT. And you are giving the value of equity, value of debt. You are now required to calculate WACC. Let me repeat my point. Deliberately, you are not giving cost of equity, cost of debt. The examiner gave you EBIT, profits before interest and tax. The examiner gave you the tax rates. You are giving value of equity. You are giving value of debt. You are now required to calculate the weighted average cost of capital. Some will be saying that there is no cost of equity here now. How do you calculate this thing now? And you have been given the earnings before interest and tax. In that earnings before interest and tax, we have cost of equity included. We have cost of debt included. All right. Please learn to approach your exam by being smart. Your being smart is you have limited hours in the exam hall. So you must look for a short route to maximize profit, to maximize mark. All right. Figure 3. The question says, ordinary shareholders. Please hold on. Let's continue. The question says, calculate return required by the ordinary shareholders to compensate them for business risk only. Please, what is business risk? Yes, anybody? What is business risk?
It is an uncertain event that has the ability to not just affect business decisions in the short term, but set a strategic direction for that business in the long term.
Okay. Please note.
There are risks that
Please
are not
do
diversifiable.
not write this. Sorry, what do you say?
I think there are risks that are not diversifiable.
There are
They
risks
are
that are not
restricted to a
diversifiable. Okay.
They
Please,
are
the two
restricted
speakers,
to
both the first speaker and the second speaker, while I appreciate your ability to speak, but they are wrong. Your business risk, this is the risk that has to do with the nature of your business. The risk that you may achieve low profits or you may incur losses due to the nature of your business. Where a company is financed by equity only, such company will only be exposed to business risk. Where a company is financed by equity only, such company will only be exposed to business risk only. For example, look at this ICAN tuition center that we run. We have a peculiar business risk that has to do with the nature of our business. There is the risk that some students can join the class. and without making payments. You know, it's very possible. That's why some school will not run online class. Some can get into the class because as you are trying to verify who has paid, who has not paid, it could be very, very taxing. That's why they always tell you to give us your name and all those things. There is the risk that with this business, they will join the class, both physical class and online class. They will take lecture for some months, and they will not come again. What do you do? It has to do with the nature of our business. Such students, we have lost income, or we lost income. So please, let this register, because if you say systematic risk, you have now gone to another thing again. Systematic risk is the risk that cannot be avoided. Business risk can be avoided. You can choose not to go into ICAN lecture center. You can choose not to invest your money in this business. Look for another business. So business risk can be avoided. Systematic risk, risk that cannot be avoided. Example is inflation risk. If there's inflation in a country, whether you invest in bank or you invest in construction, inflation will affect everybody in the economy. All right. Now, this question number 3 is that calculate return required by shareholders to compensate them for business risk only. That means if I want to calculate this, I will assume that this company is ungeared. I will assume that this company, that is the return to compensate for shareholder. If this company does not have debt finance, currently, the cost of equity is 20%. Because, okay. Currently, the cost of equity is 20%. Please note, cost of equity is return to equity holders. Cost of equity is the return to equity shareholders. Currently, return to shareholders, ordinary shareholder is 20%. Because the company is geared, we are paying them 20%. Because this company is geared, we are paying them 20%. Now, we now want to calculate cost of equity of an ungeared company. An ungeared company, a company without debt finance. That is the compensation for business risk. You can use M&M formula with corporate taxation. Just 1 minute. Let's continue. You can use Modigliani and Miller formula with taxation. Because this question involves taxation, we are going to look for M&M with taxation. Where there is taxation, the cost of a GS company is equal to the cost of equity of a non-GS company plus brackets 1 minus the tax rates. Close your bracket. Under brackets, cost of equity of ungeared minus cost of debt. Close your brackets. Multiply by value of debt over value of equity. You can use this to derive the cost of equity of an ungeared. In question, value of equity has been given to us. Here is the finance minister.
Thank you, sir. Sir, I want to ask,
Your question, please.
Have we answered the number A3 already? That is the return required by the ordinary shareholders to compensate for business risk.
Sorry, Honorable Minister for Finance. My network, there was a glitch. So can you give me a question again, please?
Okay, I was asking that the requirements number 3 for A, have we gotten the required return required by the ordinary shareholders to compensate for their business?
No, we have not answered it. We are about to answer it now.
Okay, thank you. Thank you, sir.
We are trying to answer it now.
Okay, thank you, sir.
Look at the formula you have, please. I want to define the formula. We have here VE. VE is equal to market value of equity. Currently, the market value of this equity is 300 million. The formula here, VD, that is the market value of debt. That is 200 million. Cost of equity of an ungeared company. That is what we are trying to calculate. Next, KEG, cost of equity of a geared company. If the company is geared, the cost of equity is 20%. This company is a geared company. At the start of the business, look at it, please. Look at it, please. Tesla PLC has a geared capital structure. And the cost of equity currently is 20%. So you pick it. When the company is geared, the cost of equity is 20%. So we can denote this with letter S. That's what we are trying to calculate. Cost of equity of an ungeared company. The cost of debt is currently 12.5. The tax rate is 40%. You can return to that equation. Look at the formula. Cost of equity of a GS company is equal to cost of equity of an ungeared company plus bracket 1 minus tax, under bracket cost of equity of geared minus cost of debt, close your brackets, value of debt over value of equity. If the company is geared, this is 20, you can ignore the percentage. Ungeared, we don't know. You note it with letter X. Plus, put a bracket. 1 the tax rate, 40%. Cost of equity of ungeared, we don't know. Denote it with letter X. Cost of debt, 12.5. Value of debt, 200. Value of equity, 300. We come here, 20 is equal to X. Like we said, for every alternative we choose, there's an element of risk. The network is a bit unstable. I have 12.5 cost of debt. Then I can just take 2/3 to reduce. Now work this out. This plus. Please get 2/3 multiplied by 0.6. What do you have? 2/3 first. Then multiply by 0.6. 0.4 brackets x minus 12.5. If you work that out, first of all, your calculator do 2 divided by 3. When you get your answer, multiply by 0.6. You are going to get 0.4. Please, can we confirm that?
Confirm, sir.
Now, we can open. I don't know what's happening to NCM these days. Network strength is not strong. Okay, let's continue. 0.4 multiplied by x. That will give me 0.4x. 0.4 multiplied by 12.5. Please work that out. That will give you -5. Please work that out. Then you can now have 20 is equal to, no? Let me save time here. I can collect light hands here. I'll do like this. -5 is here. That will collect light hand. That is +5 is equal to s plus 0.4s. Remember, there is 1 here. That will give me 1.4x. I can come here. and expand. What is X? This will give me $25 is equal to 1.4x. X is equal to 25 divided by 1.4x. What is X, please? Hello.
18%.
17.8, sir.
17.8.
0.8%. 17.9.
18%.
17.9%, sir.
Your answer is
18%.
S
I got
is equal to
17.9, sir.
17.86%.
0.9.
That means
0.86.
cost of equity of an ungeared. The cost of equity of an ungeared is 17.86%. That is the return required to compensate for business risk. When you say ungeared, I'm coming, please, Emmanuel and Hussein. When you say ungeared, that means there is no debt finance. Your question, Emmanuel.
Okay, I am just looking at the computation because I did it on my own end. Regarding the where I'm having issue is the cost of equity of a geared company, which happens to be 20%. But in the computation, we are using the 20 in absolute value, not in percentage, because I use 0.2. So so on my own end, I'm at the end of the day, I'm having 15.63%.
Okay,
on
even
my own.
if you use 0.2, you are still going to get 0.1786.
Okay.
Yes. So please go back. 0.2 is equal to S plus bracket 0.4 bracket S minus 0.125. You are still going to get the same answer. Yes, Minister Flo Hussein.
Yes, sir. Good evening, sir. Sorry, I'm somehow confused from that where we have 20 equals to x plus open bracket 0.6 close bracket. But the next line, instead of 0.6, I find out that is 0.4. So I didn't know what they multiplied.
You have your calculator closer to you. Now look at this, 2/3. Divide 2 by 3.
Yes, sir.
Now multiply by 0.6.
Minus 0.6 is 0.4.
That's how we get. Look at it. Now this is 0.6 multiplied by S minus 12.5 multiplied by 3/2. So I try to multiply the one without S first. I multiply 0.6 multiplied by 2/3.
Okay.
If you multiply 0.6 multiply by 2/3, you are going to get 0.4.
Okay.
After you have gotten your 0.4, now open the bracket. 0.4 multiplied by x. That will give 0.4x.
Yes.
0.4 multiplied by 12.5.
Give you 5.
That will give you 5.
Okay.
Now come here. Here you have x is here, but no x here. We collect like terms.
20
That means
plus
I'm going
5.
to move this minus 5 out. That becomes plus 5.
Yes, sir.
20 plus
Okay.
5 will give me 25. Now I have 1x plus 0.4x. This is 1x plus 0.4x. That will give me 1.4x. What is x?
Okay. Understood, sir. Thank you.
Now, Minister for Finance, your question or comment?
Thank you, sir. It was relating to the first person's question that we're having 20% in the questions, but we are using absolute value. I'm okay since you've answered that one too.
Okay. You can actually work with your percentage. The only thing is that you'll be dealing with too many points. If you pick your calculator now or write it out, that means you are going to have something like this. Let me show that what we are going to have. Let me show it here. Okay, let me put one more line. Now you are going to have, this is all now. You are going to have 0.2 is equal to x plus bracket 1 minus 0.4, close your bracket, under bracket, x minus 0.125, close your bracket, 200 over 300. Now, please solve for x. Solve for x. You are going to have 0.2 is equal to x plus bracket 0.6. Close your bracket. You have x minus 0.125. Now this will give me, to reduce the 0, 2 over 3. So you are going to have 0.2 is equal to x. Now come here. 0.6 multiplied by 2 over 3. What do you have? Emmanuel, compute.
0.4.
That will give me 0.4. 0.4 into bracket x minus 0.125. Open our bracket. 0.2 is equal to x plus 0.4x. Now multiply. 0.4 multiplied by 0.125. What do you have?
0.05.
0.05. 0.05. Collect your like terms. Like term, this will give me 0.2 plus 0.04x. I'm only doing this to give you the comfort. 0.2 plus 0.05, what do we have?
0.25.
0.25 is equal to 1.4x. That means x is equal to x is equal to 0.25 divided by 1.4. Please divide. What do you have?
0.1.
0.1.
0.18.
0.1786 multiplied by 100.
17.86%.
Whatever method you use, you are going to get this. Please, let's move on with this class. Let's look at requirement B. Requirement B says, after the change in capital structure, look at the change. Look at the change, please. Said, the company proposes to raise 25 million naira of new equity and to use the finance rate to repay 25 million naira of outstanding debt liability. That means the capital structure has changed. Equity has increased. Debt has reduced. That means your capital structure has what changed. You have introduced more equity, reducing the debt. Now the question says, after the change in capital structure, calculate one, the company's total market value, the shareholders' wealth, the company's WACC, and the company's cost of equity. Now that the capital structure has changed, what is the total value of the company? Let's go to computation. Please, when you are writing this exam, once you observe change in capital structure, once you observe that the capital structure of the company has changed, the first thing you are going to do is ungear the existing company. Let me take that again. Look at the notes. Once there is a change in capital structure, once there is a change in the company's capital structure, i.e. change in gearing level, the first thing to do is to ungear the existing company. This simply means remove the effects of the existing debt. Ungear means remove the effects of the existing debt finance. We can use M&M formula with tax to ungear the company. Where there is taxation, value of geared company is equal to value of ungeared company plus value of debt multiplied by tax. We can use this formula to ungear this company. Currently, when the company is geared, the total value is 500 million. Total value of a company is value of equity plus value of debt. If the company is ungeared, that is what we are trying to calculate now. We don't know the value yet. We want to remove the effects of the existing debt. We don't know this value yet. The market value of the debt is 200. Somebody's phone is ringing. The market value of the debt is currently 200. The tax rate is 40%. What is value of ungeared? You can return here. Our VG, value of geared, 500. 500 is equal to value of ungeared, we don't know yet, plus value of debt, 200 million, multiplied by the tax rate, 40%. Work this out. 500 is equal to value of ungeared plus 80. That means value of ungeared is equal to 500 minus 80, which is 420 million. If the company is not geared, its value will worth 420 million. You have ungeared the company. You have assumed that this company is not financed by debt. When you are done with that, now go to step 2. Re-gear the company using the new debt, value of the new debt. Re-gear the company using value of the new debt. What is the value of the new debt? Let me move us more.
25 million.
Our VU is 420. Value of new debt. Currently, the debt value is 200 million. We are going to repay 25 million. That means value of the new debt is 175 million. Currently, value of the debt is 200 million. The company plans to introduce more equity, 25 million. Let me show you the aspects. Look at it, please. The company proposes to raise 25 million naira of new equity and to use the finance raised to repay 25 million naira of outstanding debt liability. That means the debt will reduce by 25 million. out of 200 million, we are going to repay 25 million. We are left with 175 million. So value of the new debt is 175. Therefore, you can come here. The tax rate is 40%. VG is equal to VU 420 plus value of new debt 175 multiplied by the tax rate 0.4. What is the value of the new company? That will give us 420 plus 70. 0.4 multiplied by 175. What do we have?
70, sir.
70.
Value of the new company is 490 million. Look at it. Value of the company has reduced. By bringing in more equity and repaying your debt, total value of the company has reduced. Who can tell us the reason for this? The company value has reduced by 10 million. Who can tell us the reason for likely reasons for this?
Because of the optimal level of debt has been reached, as in they take more debt.
But it's repaying debt now. If that answer is correct, the company is repaying his debt. That means his debt is reducing. That reason is not strong enough. Any other points?
Sir, it is the Modigliani and Miller's theorem that says once a debt is being reduced, I mean, if the debt is reduced, the value of the company will also reduce. I just guess, sir.
Well, I think I'm trying to pick what you say. Say it's like principle. But the reason is because Emeka, you want to speak? Okay. By reducing your debt capital now, that means the company will lose the tax relief. You are repaying your debt. By reducing your debt capital, that means you are going to lose the tax relief on that debt you have repaid. Your interest will fall. Then your tax relief will also fall. That tax relief is not available to reduce your cost of capital again. The company is bringing in more equity. Equity is more expensive than debt. The cost of equity is higher than the cost of debt. Look at the question. Cost of equity is 20%. Cost of debt is 12.5. Now you're not bringing more equity. Equity finance cost is higher. That means your business cost will rise. If your cost should rise, your value will fall. All right.
So, sir, we are now saying that even in reality, cost of equity is normally higher than the cost of debt.
Even in reality, Abi?
Yes.
Are you asking a question or you are making a comment?
No, I'm confirming that statement. So are we now saying that in reality, cost of equity is always higher than cost of debt?
But that's the reality now. Cost of equity will always be higher than the cost of debt because debt finance, you always enjoy tax relief. And you will not get
Okay.
any tax relief on cost of equity. The debt holder will be willing to give you loan at a reduced cost. Why? Because the debt holder will not bear much risk. They can secure their debt on your assets. If anything happens to the business, they will just go to the assets and collect their investment. For shareholders, they are the ones that carry the higher risk of the business. Because they are carrying the higher risk, the cost of equity will always be higher. The cost of equity is return to equity holders. So in reality, and let me also say that the discussion here is not theory, or how do I put it? It's not a, how do I put it now? It's reality we are discussing. Because you are going to face reality in the business place. So we are not discussing like say, let's just go and write the exam. No, now. This is what you are going to face in real life now. Depending on anywhere you find yourself. As an accountant, you are going to be concerned with the cost of the company. Part of the company's cost is cost of capital. If you borrow money, interest will apply. That interest is cost of debt. If you issue equity to shareholders, to public, you are going to incur cost. Cost of obtaining equity finance. Okay. We have gotten the cost, the total value of the new company. Next, the shareholders' wealth. What is shareholders' wealth, please? Yes, Emmanuel.
Oh, sorry, I'm not answering the shareholders' wealth question. I just wanted to seek your approval to just help me go up on the first step of this working so that we can look at it for like 5 seconds, please.
The first step.
Yes, exactly.
Ungeared the company.
Yes. Market value of debt 200 million. Okay. 500. Okay, thank you so much, sir. That'll be all.
All right, no problem. Now, what is shareholders' wealth? What represents wealth to shareholders? If you have shares in a company, that means you are part of the shareholders of that company. What constitutes wealth to you?
The total
dividend.
investment.
I'll look at equity, the total equity.
Yeah, your total equity value. That is your total investment is your wealth. So if you want to calculate the wealth of the shareholders, try to calculate total equity value. We know the total value of the company. Total value of company is 490 million. Value of company is value of equity plus value of debt. We know the value of debt to be 175 million now. What is equity value? Difference between the two. This will give you
315.
315 million.
315.
The wealth of the shareholder is now 315 million. As a result of change in the capital structure, the wealth of this company shareholder is now 315 million. But something should strike us. I'm expecting question from here. You know why? Before now, the equity value was 300 million. The question now says, the company proposes to raise 25 million naira of new equity. I'm trying to refer you to this aspect. Look at it. The company proposes to raise 25 million naira of new equity. That means if you raise 25 million naira of new equity and you add it to 300 million, your value should have been 325 million. That means equity value. Since your value was 300 million before, you now added equity value of 25 million. Then the value of the equity should have been 325 million. What has happened? Why the value is now 315? It shows that the equity shareholders have suffered reduction in value. By bringing in more equity to the business, by issuing more shares. Remember the law of supply. When you increase the supply of a particular product, the price of the product is likely to fall because the market might be saturated with the company's products. By issuing more equity to the stock markets, we expect the price of the market price of this company and the stock market to fall. And that shows that the shareholders have suffered 10 million reduction in value. Okay. Then Roman figure 3, B Roman figure 3. Calculate the company's WACC. Now that the capital structure has changed, we are required to calculate the company's WACC now. You can use Modigliani and Miller formula. The weighted average cost of capital of a geared company is equal to the WACC of an ungeared company into bracket 1 minus value of debt multiplied by tax divided by value of debt minus value of equity. This company is a geared company. Value of debt is now 170. Value of equity is now 315. The tax rate is still 40%. We now come here. WACC of ungeared company. WACC of ungeared company is the same as cost of equity of an ungeared company. Because in Roman figure 3, we calculated return required by shareholders to compensate for business risk only. When you are talking of business risk only, that means the company is not geared. The WACC of an ungeared company is the same as the cost of equity of an ungeared company. We have computed this before. This gave us 17.86. Value of debt now. Our VD, value of debt, is now 175. Our VE, value of equity, is 315. Our T is equal to tax rate 40%. You can compute the WACC of a geared company. That will give me WACC of a geared company is equal to WACC of an ungeared company, 17.86 bracket 1 minus value of debt 175 multiplied by the tax rate over value of debt plus value of equity. Work this out. What is the new WACC? This is equal to WACC of a geared is equal to 17.8 bracket 1 minus, if you give us 70.
70, that's correct.
70 over 490. Please work this out. What is the final answer? The WACC will give you something like 15.31%.
That's correct.
Day 7. What can you see? What can you see about the WACC now? Before, the company's WACC was 15%. By bringing in more equity and reducing the debt, the company's WACC has increased to 15.31%. Look at this. Your WACC is the overall cost of capital. The cost of capital has increased. Value of the company has fallen. Any question, please?
Let God give us better understanding.
May God give us a better understanding. I agree.
Amen.
Hmm.
All right. Let's go to the last aspect of the question. Examiner says calculates the company's cost of equity. Please, as much as possible, try to understand that formula. I'm pretty sure that with the combination we are doing this die itself, by God's mercy, we expect a far better result. I can recall very well, there was a guy on this platform last diet. His name is the CAM. It's always, we call it the CAM. The guy took all the 5 paper online and he qualified. Of course, you have to play your part. That's why we encourage questioning in class. Like what Emmanuel was asking now. Some they don't normally talk in class. So if you have students asking questions, you are not only helping yourself, you are helping a lot of students. Now the capital structure has changed. Definitely cost of equity will change. We have brought in more equity and we have reduced debt. That means the capital structure has changed. It also means that the gearing level has changed. Debt has reduced. Equity increased. And that was the argument of MMM. He said, where there is corporate taxation, the cost of equity of a geared company will be lower. Look at this, please. This company is geared. Look at the WACC, 15.3. Sorry, the WACC of a geared company will be lower than the WACC of an ungeared company. Look at the WACC of this company, 15.3%. Look at the WACC of ungeared, 17.86%. The WACC of this company is lower. And he said the cost of equity of a geared company will be higher than the cost of equity of an ungeared company. We can use this formula again. We know the cost of, and I said something, please note, the weighted average cost of capital of an ungeared company is the same as the cost of equity of an ungeared company. That means you come here, look at this. Cost of equity of ungeared is 17.86. The cost of debt is 12.5. Value of debt is now 175. Value of equity is now 350. The tax rate is 40%. Now compute KEG or no cost of equity of a geared now based on the new capital structure. This becomes cost of equity of geared is equal to cost of equity of ungeared 17.86 plus bracket 1 minus the tax rate. Bracket 17.86 minus 12.5. Everything is equal to 175 over 350. Please work this out. KEG will give you 19.6 something. Maybe 6.1 or 6.5, I'm not sure now. That is the cost of equity of the company based on the new capital structure.